The latest Fed meeting minutes indicate that central bankers are very focused on bringing down persistently high inflation. But how aggressive will the tightening actually be? And how will the economy and markets respond? Well, who better to focus on all things Fed than Danielle DiMartino Booth, founder and CEO of Quill Intelligence and former Federal Reserve insider. Danielle, welcome back.
Great to be back with you, Michelle. Thank you.
All right, thank you. Let's start off with your read on the July 26, 27 minutes. As expected, they did emphasize that the participants observed that inflation remained unacceptably high and reaffirmed their strong commitment to returning inflation to the committee's 2% objective. So any surprises there? What was your main takeaway from this?
Well, I heard what they said, but by the same token, I think that the markets and we were probably a bit surprised about the dovish tone with the suggestion that they may be ready for a pause. And that goes to some recent research that came out of the Kansas City Fed that suggests that if you're in a very aggressive tightening stance and raising interest rates quickly, which has certainly been the case in the current episode, that it might be appropriate at some time out in the distance to take a pause. So that is, I think, what the surprise was, what people were not expecting to hear, especially because some of the more dovish members of the FOMC have been sounding very hawkish of late.
Yes, indeed. We had Minneapolis Fed President Neil Kashkari, one of the biggest doves traditionally, taking on a rather hawkish tone. But before we get into the big picture, I want to focus on September. So given these minutes, what do you expect for the September meeting?
I think the Fed is trying to broadcast that because they have seen certain signs that consumer spending is slowing, today's retail sales report notwithstanding, but that because they have seen some signs of the economy slowing, that maybe it would be more appropriate for investors to anticipate 50 basis points in September. But I do think that is probably a minimum. I don't foresee the Fed moving back to what we were used to before, just a 0.25 percentage point hike before the December meeting.
All right, but big picture here, Danielle, where does the Fed actually need to raise its benchmark rate to if it does want to succeed in bringing inflation back down to 2%? Is it as high as 4%? Is it as high as 5%? Where does the Fed actually need to go to get inflation under control effectively?
Well, I think a lot of people would say that you were in the right neighborhood, maybe 3.5% to 4%. And that's certainly a number that is higher than what we saw in 2018, 2019. And then there is the other form of tightening that we have with the shrinking of the balance sheet. And I find it to be very curious that Fed officials have said so very little about it. And I think that goes to show that they really don't know themselves how this tightening is going to manifest in the financial markets. We've already got some gauges of liquidity that have come down significantly, whether you're looking at M2 growth or other deposits under liabilities in a weekly release of the Fed. That liquidity measure has been going down for 5 straight months now. So I think that the Fed is treading lightly, but by the same token, I don't know that investors are paying close enough attention to what I would call the specter of quantitative tightening.
All right, well, let's focus then on quantitative tightening. The minutes did address it. There was a line there saying members agreed that the committee would continue reducing the Federal Reserve's holdings of Treasury securities and agency debt and agency MBS mortgage-backed securities. As we know, rate hikes are just one of the tools that the Fed has at its disposal here. But if you actually look at what's been done in terms of quantitative tightening, it doesn't seem like they've made tremendous progress on that front. The Fed's balance sheet, its asset size barely diminished from a peak of almost $9 trillion. The current value of the assets is at $8.8 trillion. And keeping in mind, just prior to COVID, the size of the assets on the Fed's balance sheet was around $4.16 trillion. So doubled since COVID. Doesn't seem as though they've really been too aggressive in selling these assets. So break that down for us, Danielle. What's going on there?
So there are many factors at work. In fact, I put a primer out that was free to the public because there's so much misunderstanding. Your mortgage-backed security, to take but one example, they can take up to 3 months to settle. So even though the Fed has stopped increasing the holdings of its mortgage-backed securities, there might have been securities that it purchased prior to starting quantitative tightening that took 3 solid months afterwards to settle. giving the impression that the Fed was still conducting quantitative easing on the MBS side. Separately, when it comes to treasuries, the goal was beginning in June. This was an announcement that the Fed made in May, beginning in June, that the Fed would reduce the amount of treasury holdings by $30 billion. That level is going to be doubled in the month of September. And the wrinkle here that I think people need to understand, just it took me back to business school. I can't remember the last time I studied, when does a treasury mature? Well, as it turns out, treasuries mature on the 15th of the month and on the final day of the month, the 30th or the 31st. And what that means is that quantitative tightening itself did not begin until June 15th. And that's why we're only at $53 billion, even though we will get another slug of quantitative tightening. You'll see it tomorrow when the Fed's balance sheet report comes out, showing that because August the 15th is going to be incorporated into this next report, you'll see another slug having run off. So but the point is, by the time we get to the first week of October, which reflects the September the 30th maturing of treasuries, you will see that the Fed is reducing its balance sheet by that $60 billion a month. And I dare say that we're going to stop debating whether or not the Fed is tightening and beginning to speculate on how much the tightening and the depletion of liquidity in the markets is affecting investors.
All right. So you're saying that the markets aren't really taking this part of the equation very seriously at the moment in terms of market sentiment, that they're not really factoring in what's going to happen when the Fed does really start to sponge out this liquidity with a tightening process.
That's exactly what I'm saying. And I think that investors should be very careful to not conflate the Fed saying it might be appropriate to reduce the size of these unusually large Fed fund rate hikes of 75 basis points. That is not one and the same with the Fed saying we're going to stop shrinking the balance sheet. Chair Powell and others have been very careful to distinguish between the two. And I think that even if the Fed did do something unusual, and I've actually been advocating for this, Michelle, I have suggested that because the November FOMC is only 6 days before the midterm election day in the United States, that it would be highly appropriate for the Fed to say, we're going to pause at the November meeting and resume rate hikes in December and call a communication blackout. Now, hopefully they're watching this segment and hopefully they take my advice. But if they don't, my point would be the Fed is going to continue shrinking that balance sheet, and investors should not say just because they're going to stop hiking rates means that they're going to stop pulling liquidity out of the markets, which is another form of tightening that markets really did not like the last time they attempted this.
Right. So definitely too much focus on the rate hikes themselves, not enough on the asset purchases. But I want to go back to your point on why you think it's a good idea that the Fed, ahead of the midterm elections, takes a pause and takes a communication blackout. Why would you advocate for that?
So I think that Fed communication, Fed speak, as we say, has become its own distortive element in the markets. There are too many people saying too much, and even when they're all towing the same line, as we've seen in the case of Mary Daly of San Francisco, Neil Kashkari of the Minneapolis Fed, Charlie Evans of the Chicago Fed. These are true diehard doves, and they're coming out and being very hawkish. That's confusing to investors. So the Fed is an independent apolitical institution, according to the Federal Reserve Act of 1913. It's unusual to see a Federal Reserve meeting this close to Election Day. There's a rotating schedule. Sometimes the September meeting might fall on the 16th. This year it falls on the 21st. That's pushing the next meeting a little bit further out on the calendar. But because we're in such contentious times, and because both parties want to pin the blame for inflation on the Federal Reserve, and because the Fed is already contemplating pausing, I would advocate for them to step back and extend the 10-day blackout period that is prior to every FOMC meeting, take a pause at the November meeting, continue quantitative tightening in the background, to quote Jay Powell, and then resume communication after we get past Election Day so as to not have the appearance of trying in any way to influence the elections in such contentious times in America.
All right. So Danielle, assuming they follow your advice, assuming there's a pause there, but as you say, they continue to reduce the balance sheet. When the market does start to feel that, what does that look like?
You know, there was a very good article over the weekend in the Financial Times, and it was a veteran investor saying that the first phase of investor agita, of investor anxiety with this Fed tightening campaign, that we've pretty much come through that is the Fed responding with rate hikes to high inflation. The next stage, he said, would be when defaults start to pick up materially in the fourth quarter and into 2023. You have to, I mean, liquidity is exactly as it sounds like it is. But when you have a $12 trillion corporate bond market in the United States, you have to have capital markets that are deeply liquid and able to roll over the refinancing needs of corporate America, 20% of which are zombie corporations and will have a harder time accessing capital as the liquidity is taken out of the system via quantitative tightening.
So look, Danielle, it sounds to me as though you're saying it's going to get quite a bit uglier.
I think things are going to get sketchy. Look, I could be wrong. We could see Powell pivot, but Powell himself recently said, I don't want to be the second coming of Arthur Burns. And Arthur Burns is, of course, the former Fed chair who did let inflation go wild on his watch and caused the country to have such economic weakness for such a prolonged period of time that Paul Volcker had to come in and tame it. Because Powell has said that, I'll be paying very close attention to what he has to say at Jackson Hole. I don't think I'll be alone.
Right.
And especially, again, what they do with quantitative tightening. If they don't change a thing, we're going to be up and running by the time October rolls around at a level markets do not appreciate.
Okay, so let's talk about this idea that the Fed will pivot, stop, pause, or even reverse course if the economy either contracts too aggressively, if markets start to sell off, if the market sell-off starts to accelerate, or if the situation somehow looks like it would have steadied enough. I mean, we do have a sense that markets are in a way banking on this, or at least hoping that this will happen. In your opinion, are the markets overestimating the likelihood that the Fed will be in some kind of a position to start cutting interest rates next year?
I think they are. I think the market is well over its skis here. I think that it's one thing to say that we're going to pause and allow the lags of monetary tightening to percolate through the economy. It's a completely different proposition as long as inflation remains appreciably above the Fed's 2% target. Everything that we've seen before you and I started taping today, we were talking about home prices being at record high levels. That type of inflation is very sticky, as we call it. It tends to move through the consumer price index with a 5-quarter lag. So as long as inflation is uncomfortably high, I would suggest that even if the Fed does pause with its rate hiking campaign, it will want to continue with quantitative tightening and not ease anytime soon. I give Jay Powell credit, and I'll be the first one out there publicly to give Jay Powell credit if he breaks investors of the mindset that regardless of how much risk they take, the Fed is going to have their back. Breaking that mindset would restore credibility at an institution where it's sorely needed.
So although markets are hoping that this will happen, you do think that if the Fed becomes less aggressive with tightening, and if the Fed pauses with rate hikes by the second half of this year, or even reverses and pivots by early next year, you do think that this would be a big mistake?
I certainly do. If Fed officials right now can't look at what's happening in the SPAC space or what's happening with meme stocks all over again and say ultra loose monetary policy, overly easy financial conditions leads to speculation in the worst form. If they can't recognize that overly easy monetary policy has been what's fed this speculation and risk taking to too great of an extent, then they're absolutely blind. And they'll unleash the next form of it, and we'll have an even bigger bubble inflate. Jay Powell is not a PhD in economics. He's a markets person. I think he recognizes this.
So given the markets, Danielle, there's a lot of speculation whether we are in a bear market rally and it's going to get a lot worse, or that we may have somehow found a bottom here. Where are you on this?
Well, I think I would definitely put myself in the bear market rally camp. One of my mentors, Dr. Lacey Hunt, has always taught that two sectors in particular lead economies in and out of recovery and recession, and that is the automobile sector and the housing sector. We are indeed seeing automobiles come down hard. We're seeing used car prices come down hard, inventories rise, things we never thought we'd be talking about a year ago. And we're seeing housing hit a very hard wall. And it looks to be, despite the fact that mortgage rates have come down, we're continuing to see activity curtailed in housing. That suggests to me that we are still going into recession, as opposed to being able to step back and say, "Oh, we made it out clear and fine. We found a bottom. Markets don't have any more downside." I think that that's naive.
Well, look, Danielle, I will give you credit. You were 100% right when you were on this show, and you said that there is no way the stimulus does not cause inflation. And you were 100% right when you said that calling inflation transitory was ridiculous. So give me your specific outlook on where you see the U.S. economy going by this time next year. Paint me that picture in as vivid a detail as you can.
So I don't necessarily see, because of the political backdrop, I don't see any major form of stimulus going directly to U.S. households until maybe March or April of 2023, after we have the new Congress sitting in session. If the Republicans take the House, I don't think that stimulus measures are going to look anything like what they looked at like after the pandemic. And that messages to me that if we're already in recession and we're not going to get major forms of relief for the U.S. household sector, that we're going to remain in recession for longer than most people think, that it's not going to be this convenient, shallow and quick recession, that we're actually going to be in it for at least 4 quarters, if not more. We might be coming out of it at this time next year, but I don't foresee a recession being quick and neat, as most sell-side analysts on Wall Street would have you believe.
So you're looking for a deep and prolonged recession is what you're forecasting?
It is. We have more leverage in the system today than we had going into the pandemic, when we were also going into recession then. And more importantly, the rest of the world is in worse shape than the United States is in. We know that China is in recession. We know that Germany is in recession. So you cannot act as if the United States is on an island. It's an exporting nation as well. So we have other factors that are actually worse in terms of a baton handoff than what we had at the end of 2019.
So markets are being a little bit too optimistic at the moment, fair to say then?
Again, I will be the first to say I am wrong if we see a major Powell pivot, and it will be a mea culpa, and I will be slaughtered on Twitter, and I'm fine with that too. But as things stand right now, a man who says, I don't want to be the next Arthur Burns, I don't see stepping back. And if that's the case, and he's going to hold true to tightening and pushing forward, even if it's at a lower rate, then that is certainly not what markets are pricing in today.
Okay, well then let's talk about Fed credibility, because it is fair to say that the Fed has lost quite a bit of credibility, being behind the curve with raising rates, saying that inflation is transitory. Is that a fair statement? That they've lost credibility?
The Fed has absolutely lost a ton of credibility. It didn't help that the Biden administration was so very slow in deciding who was going to be the next Fed chair, whether Jay Powell was going to be renominated or whether it was going to be Lael Brainerd. When you create a crisis of confidence at the highest leadership at the Federal Reserve, you're going to have policy become paralyzed. And that's exactly what we saw. And it was echoed by Randy Quarles in one of his first interviews after he left the Federal Reserve Board. So the Fed knows that it needs to reestablish credibility. Powell knows that he's in office for 4 years. And I dare say he's got his legacy to prove at this point, because the man is worth upwards of $100 million and could have gone off and played golf and returned to his posh life in private equity. And he chose not to do that. And if that's the case, I think he is trying to safeguard his legacy and bring inflation down.
So that means you anticipate a more aggressive Powell, if for no other reason than to save his own legacy after this. Is that what you need to see from the Fed to have your confidence restored?
Oh, absolutely. It's no secret that Paul Volcker was Jay Powell himself. He idolized him. He was his mentor. He meant to, if you read the 2012 and 2013 transcripts, the old Jay Powell doesn't sound anything like wishy-washy, bend over Jay Powell at all. And I think that he wants to bring back that reputation that he once had when he was new to the Federal Reserve Board and reestablish the institution's credibility by bringing back his own.
Well, you mentioned Congress, and as the Fed is fighting inflation, we're going to have more money into the system with the impact of the so-called Inflation Reduction Act, President Biden signing it in. Now, granted, it's a far reduced version of the $1.75 trillion Build Back Better plan that he was pushing for last year. But we do have another $437 billion getting back into the economy, a big spending package there. What impact do you think that the Inflation Reduction Act is going to have on all of this?
So I think the critical distinguishing factor is the difference between how the fiscal stimulus was crafted. In other words, direct deposited into U.S. households' checking accounts. That's much, much more different than saying you're going to get a tax credit if you're green. So it's day and night. It does not have the immediate stimulative effect. And anything that Washington says is going to reduce inflation by nature should increase it.
Well, right. So then how do you see it playing out then in real terms?
I see it as really not being very stimulative at all. It seems as if there might be some good initiatives that come out of it. I live in Texas part of my life. Maybe I'll put some solar panels up on the roof. Maybe I'll get a tax credit for doing so. But this was much more stimulus crafted in the old mold of Congress rather than let's modern monetary theory, universal basic income, just hand the cash directly to the people, in which case the cash is immediately spent.
Well, we're talking about helicopter money and handing cash directly to the people. And it just happens to be that 51 years ago this week is when President Nixon ended the gold standard, effectively allowing MMT to take shape and form in one way or another. But we're seeing gold prices remain under pressure below the $1,800 an ounce level, even though July CPI data came back a little softer than expected. We're still up 8.5% from a year ago. We still have inflation at 40-year highs. Mm-hmm. Is gold performing as you would expect it to?
No, I certainly still have my gold holdings, and I think a lot of people who own gold are highly frustrated right now. What we've seen in the post-pandemic era is that gold can be used for many purposes. It can be used to satisfy a margin call. We've seen that happen not once, but twice since the pandemic hit. And then there's the confusion. Boy, I'm going to get lambasted for saying this, but there is the confusion that's created by this illusion of Bitcoin potentially, or cryptocurrency in some form, potentially also being an inflation hedge. I think that has taken away some of gold's appeal. But again, you put your money where your mouth is. I certainly am not getting rid of my gold holdings, because if anything that I've described today with quantitative tightening comes to pass, that is going to be very financially disruptive. And when you have financial disruption, any type of a financial crisis, in addition to a recession, gold tends to be the only place that you can find diversification.
All right, Danielle, you mentioned the housing market earlier, and it was in fact a concern that you flagged last time we spoke in May. So let's focus more on the U.S. housing market. Affordability in the U.S. housing market at its lowest point in 3 decades now. The S&P Case-Shiller U.S. Home Price Index is at the highest it's ever been. The median price of homes in the U.S. is also at the highest level, with the average home in the U.S. to date being sold for $440,000. Many are worried about the prospect of another housing bubble collapse. Elaborate on that.
So I think it's absolutely magnificent to look at some of these data points on charts. In fact, I'm writing about 4,000 words just about housing this week. Whether you're talking about single family permits, whether you're talking about single family starts, rents on apartments are beginning to roll over. Investors are pulling back. Second home sales are absolutely collapsing. So what you're seeing is the smart money trying to get out ahead of the last buyer to come in when the market is this frothy. And we are indeed, if you look at purchase applications on a weekly basis, so many of these indicators have had massive pullbacks. And I don't think that anybody disputes right now that housing could be in for a very long winter.
All right, so you expect a lot of pressure on the high end of the housing market. If I may recap here, you don't think we've hit the bottom in the equity markets, that this is likely a bear market rally. You think that Jerome Powell is going to have to restore his credibility and legacy and hold the line, continue to tighten, that he won't pivot, and that ultimately we're going to go into a deep, prolonged recession. Assuming that's an accurate recap, Danielle, how should investors position themselves now?
Right now, we're seeing the higher end market be impacted much more than your more affordable area. And that stands to reason. We're also seeing markets that were the hottest markets. We're seeing the biggest pullbacks in them. And that stands to reason because where speculative dollars flow, they tend to come out the most quickly as well. So again, there are a lot of people of wealth who, after the pandemic and the Fed came riding to the rescue and 401k passive flows flowed right back into the stock market, they chose to have a second home or winterize their home. Now they're saying to themselves, why do I have 2 property taxes? Why am I carrying 2 mortgages? Mm-hmm. And that's why we're seeing a reversal of some of this mammoth, one-time idiosyncratic wave that moved to the housing market, backing away from it. So I think affordable housing, reasonably priced homes is still going to be a good place to be, especially if we see mortgage rates come back down. But I do see major pressure coming, especially at the high end for housing.
Okay, so you have pressure on the high end of the housing market. You do not think that we've hit the bottom. You believe this is a buyer market rally, if I may recap here. And you think that Jerome Powell is going to have to fight for his credibility and hold the line, maintain a firm position that he won't pivot, and that ultimately we're going to be in a deep, prolonged recession. If that's an accurate recap, Danielle, how should investors position themselves now?
Well, I think investors should take advantage of the run-up that we've seen in stocks to pare back some of these positions. If you didn't feel like you had the window of opportunity to do so in June, I think that an acute focus on strong balance sheet, I'm not talking about share buybacks, I'm talking about dividends, companies with great cash flow. I would focus on those in order to be defensive, but yet create income generation for your portfolio. And I think that long-term treasuries are also going to be a good place to be, in addition to your precious metals.
All right, Danielle, always a pleasure. Thank you so much for sharing your thoughts with us. Great to have you back. And I look forward to seeing you in person soon.
Likewise. Take care.
All right. Thank you. And thank you for watching Kitco News. I'm Michelle Makori. Keep it right here.